Hi there everybody and welcome back to another stock analysis of video. Today we are going to be analyzing, guys, one of the first companies here that's actually not a bank for Q3 of 2022, and that is none other than, of course, Pepsi Cola. Guys, not the first time we've done this, and it's actually something really interesting that I noticed in regards to Pepsi Cola. We'll see this very soon in the video, so be on the lookout for that. But nonetheless, guys, they do have earnings coming out tomorrow, Tuesday, the 12th of July before open. So let's actually take a look at this company and whether or not we would like to buy it right now based on certain assumptions. So with that said, let's get started with this analysis. Alright guys, we are going to come right into the dividend summary. This is actually one of the main reasons why some people actually like Pepsi Cola, because they do have a very good dividend. And it's actually right here on this page. You guys are seeing it. I don't know if you noticed yet, but, well, they recently hit a pretty big milestone, if I do say so myself. But I do have a couple of bad news. But nonetheless, dividend yield, guys, of 2.68%, which actually ends up being a whopping $1.15 per share. That's not too shabby. This actually comes out to be $4.60 annually. Now, the reason why I said I kind of have a couple of bad news is because, unfortunately, this dividend isn't necessarily that sustainable in according to this payout ratio that Seeking Alpha gives us, right? 67.93% is very high. I like to buy anything under 60. You do not want a company to be putting out majority of their cash flow into their dividend, right? You want them to still have a little bit of cash flow left in order for them to grow, to make acquisitions, to buy back shares, and to pay down their debts, right? Unfortunately, as it stands, well, in accordance to this payout ratio, it is a little bit high. We're going to take a look at the payout ratio in regards to the free cash flow in just 1 second. But now looking at their 5-year CAGR, guys, this isn't that bad either at around 7.39%. And the big one that I actually wanted to point out, and the one that I mentioned earlier, is the fact that, look at this, guys, 50 years of dividend growth. You know what this means, right? Pepsi Cola has actually become a dividend king. The last couple times I've actually analyzed them, they were at 49 years. And I was just like, one more year until they become dividend kings. And congratulations, Pepsi Cola, you finally became a dividend king. Hopefully you're able to sustain this, because unfortunately cash flows and payout ratios aren't looking too hot. We'll get to that when we get to that. Now, ex-dividend date, guys, actually passed as of June 2nd. Payout date was actually the same month, June 30th, and they pay their dividends quarterly. Now let's come into the calculator and analyze this a little bit further, starting of course with the basic premise of Pepsi Cola. Ticker symbol of PEP, market cap of a whopping $235.7 billion, PE of 23.31. Now I have this in red because I like to buy anything under 20. Does this mean that with a PE of 23.31 it's a no buy? No, it just depends, right? If a company is willing to grow at a much higher rate than what you actually think, then this PE might actually be a pretty decent buy right now, right? But with the current share price of $170, I don't necessarily know, right? I just don't necessarily know. And on top of that, they barely even moved on the year to date, only falling at around 1.5%, which means that they have been pretty stable all throughout the entirety so far of 2022. But nonetheless, looking at this $4.60 in dividends annually, guys, in accordance to the shares outstanding, this is $6.4 billion being paid out in dividends every single year. This is massive, and here's the reason why. After this dividends payout, if we take a look at their 5-year average free cash flow, they're only left with $32.28 million. Not 32 billion, not 320 billion, no, $32 million. That is not good. And now if we do the exact same thing in regards to last year's free cash flow, it's a little bit better, but nonetheless, they only have left $628 million. Guys, that's not good at all. And now if we actually take a look at these payout ratios in regards to the cash flows, we can see that they are not that sustainable, right? Last year's payout ratio was around 91%, and the 5-year average is 99.5%. That is not good. Once they reach 100%, guys, they are essentially taking on debt to pay out this dividend, which is not something you want to see. So as it stands, I understand that they just made Dividend Kings. They may want to keep it, but I would actually suggest that they would either stop issuing increases in dividends or cut it a little bit here, because their free cash flow is not sustaining this dividend at all. Now let's actually take a look at some fundamentals, starting of course with the net income. Guys, 5 years ago of $4.8 billion to 1 year ago of $7.6 billion, increase of 57%. Now you're probably saying, oh, that's actually not bad of an increase. Except that this graph is very, very bad, especially for a company like Pepsi. Out of all companies, Pepsi? Really? Guys, look at this. You went from 5 years ago of 4.8 billion to 4 years ago of 12.5 billion. Pretty good increase. And then from 4 to 3 years ago, 7.3 billion, a drop. Then another drop to 7.12 billion. And then a tiny increase to 7.6 billion. The only reason why this is saying this is 57% increase is because their 5 year ago number is significantly more than their 1 year ago number. Once we get one more year's net income and this graph shifts over one to the left, you will essentially have decreasing income, assuming that this year's is actually less than $12.5 billion. So as it stands, guys, I get that the metric is increasing right now, but it's not that impressive if I do say so myself. Now coming over here, guys, to the free cash flow, the most important profit metric to analyze, because cash flow, it is essentially everything. A company operates based on free cash flow. It makes acquisitions, it grows, it buys back shares, it issues a dividend, and it pays down their debts. So you really, really need free cash flow to be really solid, because if it's not, we could fall into some issues. Now, as you guys can see here, 5 years ago of $7.1 billion to 1 year ago of $7 billion. That is a decrease, guys, of 1% with a 5-year average free cash flow of $6.4 billion. That is very surprising and not good. If we actually see into each individual year, we can see that from 5 years ago to 3 years ago, they were actually decreasing. And then from 3 years ago to 1 year ago, they started increasing. I have no idea where this is going. I gotta be honest, I have no idea where this is going. But nonetheless, as it stands from what I'm looking at right now, this is actually not that impressive, and it's again really, really surprising for a company like Pepsi. And lastly, looking at the revenues, this metric is actually looking pretty good. However, it is the least weighted out of all of them. We got 5 years ago of $63.5 billion to 1 year ago of $79.4 billion. That is an increase of 25.11%. Very, very nice, increasing steadily, staircasing as I like to call it, staircasing. But unfortunately, revenue, it's good, that's increasing, but it's the least weighted out of the 3 profit metrics that I like to take a look at. Now let's take a look, guys, at the total assets minus the total liabilities. Basically, will the company be able to survive if we go into a recession? If they were to liquidate their assets as kind of like a last minute kind of thing, you know, oh my god, we can't do anything, liquidate all assets, can we cover it? If the answer is yes, then this number will be positive. If the answer is no, then they'll go into bankruptcy. So essentially today, guys, Pepsi is able to do this at a whopping $18.3 billion difference, which is really, really good, right? And on top of that, again, to their credit, unlike what we just saw with the profit metrics, they've actually been increasing this fairly consistently. They had a bad year 2 years ago, but that could just attribute that to COVID, right? Nonetheless, this is looking very, very good. Average total assets around $85.7 billion, average liabilities around $71 billion, and doing this difference, we get $14.7 billion. Now let's analyze the metric of cash flow minus the total liabilities. This metric we didn't have when I actually did Pepsi before, so really good that we're doing it now. Essentially, guys, a company uses their free cash flow to pay off their liabilities, to pay off their debts. So we want to see if throughout the past 5 years, has the company been increasing their cash flow and decreasing their liabilities to the point that their cash flow may have offset their liabilities, which would be amazing. Now, as it stands, guys, this is not the case. We just saw the free cash flow, and as you can see, it's not that good, right? It's been pretty stagnant, and we can see that reflected here too. Basically, pretty stagnant all throughout the past 5 years. 1 year ago, they did have negative $69 billion, but overall, they've been roughly at around the same mark, which is kind of underwhelming, honestly. Now, if we take the average cash flow minus the average liabilities, we get around negative $64 billion. And now guys, let's come over to the shares outstanding, the metric that people tend not to overlook. Here on this channel though, we are not overlooking this because this is a very, very important metric that we cannot overlook, because this is the one that tells you if a company is diluting you as the investor. You want a company, guys, to be buying back shares, to use that excess free cash flow if they pay a dividend after this dividend is paid out, to buy back shares and of course to pay down debt. So you want this company to buy back shares because of the fact that this gives you, the investor, a bigger piece of the company by default. Now, as it stands, when it comes to Pepsi, not too bad, right? 5 years ago of 1.4 billion shares to today, guys, of 1.38 billion shares. On the 5 year, this is a decrease of around 2.6%. However, from the previous year to the current year, they did increase it by around 0.01%. This is looking at 1 year ago to today, again, tiny increase of 0.01%. Not too bad. That's actually not bad at all. And, you know, they are decreasing their shares outstanding, thus giving you guys a bigger piece of the company. And lastly, when it comes to their cash equivalents, they currently have around $6.5 billion with an average cash of around $7.5 billion. Alright guys, now it's time to make some assumptions. Low, median, high using 3 different factors: revenue growth, predicted share buyback, and of course, the required rate of return, which I like to keep flat, 10% to match the S&P 500 on average, right? So for the revenue growth, guys, let's come over here to Seeking Alpha's growth tab, and as we can see, the revenue growth year over year, it has been 13.38, and the revenue growth forward is around 7%. So let's take that into account when making these assumptions. So for the low assumption, guys, let's say that the revenue growth will be at around 6% within the next 4 years. For the median assumption, let's say around 10%, and for the highest assumption, let's say around 14%. And now for the projected share buyback, unfortunately, they've only bought back around 2.6% of shares. So let's just go 1, 2, and 3% respectively for each assumption. Now with this, guys, we get a target share price, not adjusting for debt, for the low assumption of $92.80. For the median assumption, it is $107.30, and for the high assumption, it is $123.58. Now we need to adjust for debt, which, as you can see by these numbers, they do have a lot more debt than they do cash and equivalents, bringing all the prices down a significant amount. Lowest assumption, now it is $73.39. Median assumption, it is $87.69, and highest assumption, it is $103.77. Now, adding a margin of safety on top of this of 5, 10, and 15%, this puts me between the range of around $62.38 to $69.72 for the low assumption. For the median assumption, it is $74.54 to $83.31, and for the high assumption, it is $88.20 to $98.58. Guys, the current share price is $170. So pretty much based on every single assumption that I've made so far here, you would need it to drop at around $70 to $80 or so. Now, probably some of you guys are saying that will never happen. That will never happen. Well, understand that, guys, companies fall to eventually their fundamentals. Eventually, a company will trade in accordance to their fundamentals. This is a fact, right? Every investment is the present value of all future cash flow, and eventually the company will come to a correct price as to what you should buy it based off of what you assume. Now, does this mean that you should absolutely not buy it in accordance to these numbers right here? No, because these numbers are based off of my assumptions, right? For example, let's just say that you think that Pepsi might not grow at 14%. You think they're going to grow at 25%, and they're going to start buying back shares at a whopping 5%. Right now, the target share price is $177, essentially saying that at the current share price of $170, it is an all-out buy, right? But that's, again, every investment is the present value of all future cash flow, and since none of this is financial advice, I have this calculator, guys, available for all of you guys to have, like I always say in every single video, and I promote it because I want you guys to have a process when it comes to investing, right? Don't just invest because, oh, I like the company and this is what they're planning to do. No, take a look at what they've done, take a look at the money that they've generated in the past to then make assumptions into the future, and then once you figure that out, then you can take a look at what they're doing in the future, right? That's essentially the way that I suggest you should invest, because that leads to the best returns, and it's a tried and true way that most billionaires, even Warren Buffett, even takes into account. So that is essentially why I have this calculator, guys, available for free, as well as my book value ratio calculator, a reevaluation, and a dividend tracking sheet, all for you guys to have just for free. All I'm asking for in return is like, subscribe, comment, help me grow my channel. Thank you so much for the 700 plus subscribers. Oh my god, that's mind-boggling. I still can't believe every single time I see that number, I'm just like, how are so many people? Oh my god, that's crazy. So thank you all so much. It's been amazing. I'm more than happy to give you guys these free calculators. Hopefully y'all enjoyed the live streams last week. Unfortunately, that won't happen for quite some time because, again, I have a 9-to-5 job. I can't do that as my permanent job, at least not yet. Maybe one day in the future, but yeah, that's essentially that, guys. Have this calculator, make your assumptions, because every investment is the present value of all future cash flow. So now let's actually take a look at this dividend. Let's say that you want to invest in this company solely for a dividend. You know, ignore the fact that they are probably not going to be able to afford it very, very soon. But let's just say that you put in 1 month's income at the average US income at $5,725 monthly. At the current share price, guys, this gets you 33.59 shares, and at the current annual dividends per share, this generates you around $154.50, quarterly dividends of $38.62, and a monthly dividend of $12.87. Now, yeah, it's good, don't get me wrong, but there are better ones. I mean, we just looked at Morgan Stanley yesterday. They were giving you, what, $211 if I'm remembering correctly? Come on, right? That's a whole lot better than this, obviously. And on top of that, Morgan Stanley's free cash flow, and on top of that, Morgan Stanley's payout ratio was way better than Pepsi. I mean, it was still fairly decently high from what I remember, but it wasn't 99%, right? So right then and there are better companies out there when it comes to a dividend for the same exact price. All in all, guys, this is a company that I actually own. I also own Coca-Cola, which, by the way, when we get to Coca-Cola eventually, when they have earnings, you will see just how different, in a good way, Coca-Cola actually is, because you would think that Pepsi's better. Actually, the opposite. Coca-Cola is way better than Pepsi when it comes to their fundamentals. So we're going to take a look at that when eventually that comes out. I own both, and I thought that Pepsi was good when I originally bought it. I still hold them. I don't want to sell them, but nonetheless, it's still not that great fundamentals. The fact that we just look at them, right? It's not that good. Free cash flow is kind of meh. Net income kind of meh, you know, and the shares outstanding is good, but it could be a lot better. So it is what it is. But all in all, at least for me, I'm not necessarily selling, but I'm also not buying at this current share price. That pretty much is for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. As I said, you guys can follow me on my music sites, all link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.